Hi, Thomas here for another episode of Tax Smart Q&A. And in this episode, I'm going to answer the question, can you take losses from your short-term rental property against your active W-2 or business income if you have a partner on your short-term rental? Before I dive right into that, if you do want to see more Tax Smart episodes, be sure to hit that subscribe button so you don't miss out on future releases. Also, if you do like the video, go ahead and hit that like button to help get this video into the hands of more real estate investors and help them become tax smart. So, to answer the question, can you use losses against your W 2 or other active income if you have a partner in your short term rental activity? Well, the answer to that question, like many things in tax, is it depends. And this is because, assuming you're using the short term rental loophole, you still have to materially participate and prove that you materially participated in your short term rental activity in order to take the losses against your non passive income, such as your W 2 or active business income. And this is done at the individual level and not the partner level. So this means that each individual has to materially participate, not the partnership as a whole. Well, if you watched other episodes here on the Tax Smart Investors channel, you know that there are generally three material participation tests that are relevant to short term rental investors. And if you're going to use two of them, two out of the three require you to either A, do substantially everything yourself. So, in other words, you're a one person show, or B, work more than anybody else. That means that two people cannot work more that means two people cannot work more than the other person. So only one person can actually achieve the tax benefits if you use either of those two tests. And what it comes down to is that for all partners or two partners or how many partners that you have in your short-term rental activity, for all of them to take the losses as non-passive, each partner would have to spend more than 500 hours on the activity, which can be quite challenging to do on a single short-term rental and may not always be possible or easy to substantiate and uphold under an audit or in tax court. So there's something to be aware. So to summarize, in order for all partners to take losses against their W-2 or other non-passive income, they must each spend 500 hours or more on the short-term rental activity, or one partner can qualify and take the benefits if they A, do substantially all of the activity themselves, or B, work more than anybody else. But if you want to take one of those two tests, not all partners can be able to qualify. So do you have questions about how the short-term rental loophole and material participation work? If you have partners, go ahead, drop them in the comments to this video. We'll go ahead and get you some answers. That's all for today, and we'll catch you on the next episode of Tax Smart Q&A.